Hi, this is Paul Canner with Trustmoral Mortgage. Welcome to our webinar. This is something that we put together to try to keep our referral partners on top of things happening in the mortgage industry. We've had some pretty quick recent changes pushed down from the federal government that do impact things, and maybe another item that may delay closings if we're not careful. We're very glad that you decided to join us today. And the fact that you're here means that you too are trying to keep up with changes. A lot of things have been going on in the mortgage industry these days, as we all know. So anyway, things seem to be running a little bit slow these days, and there's a lot of reasons for that. And on top of things, recently, as a lot of you know, we've had changes to the appraisal process due to the HVCC, which is basically something that the New York Attorney General has kind of pushed down the rest of us in this country. It is impacting us in Virginia, Maryland, North Carolina, these areas that we serve, even though it was something that the New York Attorney General wanted to do. Basically, it does not allow for us involved with the actual loan process to be in contact with the appraisers on conventional loans. So we're kind of forced to use these third-party appraisal management companies, which has slowed the process down and has caused issues with the quality of the appraisals, has actually killed a few deals, and has made some changes on the others, not to mention the number of huge issues that our underwriters and industry-wide underwriters are having with the quality of appraisals. Sometimes the appraisal management firms, for whatever reason, are picking appraisers that are not familiar with certain areas, and therefore they may not know the value of the school systems and so forth, and how to pick the best comps. So that's one thing that we're still struggling with. We add that to the extensive amount of quality control. As you know, investors in mortgage-backed securities, or the mortgage that we have, are very, very cautious right now and are requiring that we do just extensive amounts of quality control. So that has been slowing the process down some. It's probably ensuring that the investment grade of these mortgages are good. Hopefully that's keeping rates down low. And underwriting's being extremely particular. Gone are the days of you got great credit and we'll give you a loan. We trust that what you told us is true. Remember, trust and verify. Ronald Reagan had said that. And it seems like we're even checking DNA these days. So I'll tell you, some of our borrowers sure feel that way, and apparently it is just an industry-wide thing that we're just being extremely cautious. The super cautious pendulum has kind of swung to the overprotective end, and it probably had swung a little bit too far the other direction. So hopefully we'll find out somewhere in the middle. But again, all this has really equaled us to fairly long turn times, as a lot of us have become accustomed to, especially when we throw in the low rates in the refinance business. Let's give you a little bit of background here. On July 30th of 2008, that's 2008, Congress enacted the Housing and Economic Recovery Act, which included a section called the Mortgage Disclosure Improvement Act, or the MDIA. And this is what we're talking about, some of the provisions here, as well as on July 30th of 2008, again, the Federal Reserve Board published their amendment to the Reg Z, or Truth in Lending, which was scheduled to take effect this coming October 1st of 2009. Well, hey, we're in July. What's going on? We'll talk about that in a second. This is what we're talking about today. This is a scary-looking document, but it's our Federal Truth in Lending Statement, and this is required on all mortgages. It's a great tool if somebody is comparing loans and they plan to keep the loan for the life of the loan. So on a typical 30-year loan, if a homeowner is going to get that loan and keep it for 30 years, make their payments on the first of the month, never prepay anything, and never sell the house or refinance, this is a great tool, and you ought to look at the APR. It's very, very rare that that's really the case. But this is what we've got, and we're going to go with it. So back to the what's going on with the dates here. The Federal Reserve on May 8th of this year, May 8th of 2009, decided to move the deadline from October to July, which kind of put our whole industry in panic mode. And up until about July 28th or 29th, we were still figuring out exactly how to deal with this. This is a short time. And again, the requirements take effect, according to the regulation, on applications that have a date. That's mortgage applications that have a date of July 30th or newer. So July 29th is excluded. Let's start with the first thing in these rules of this regulation. Any fees other than those for credit report services may not be collected from a borrower until the initial truth in lending disclosure has been made. And again, that's something to think about. The creditor may assume, and now this is where we get into a little tricky area here, that the borrower receives the initial truth in lending disclosure on the third business day after one is mailed. Now, if Trustmore is acting as a lender in a transaction, and we typically will get, and I always have had the truth in lending disclosure done at the time of application. First of all, it's a very scary looking document, and we like to spend some time with our borrowers explaining what it means. And so we typically will get it signed at the application time. However, even though we do that, sometimes we will end up brokering a loan as opposed to acting for the lender because we may get better terms for the borrower. And after all, we're all looking out for the interest of our borrower, your buyer. So if that's the case, the actual lender of record will need to issue the truth in lending statement. So they would typically mail that out, and we'd have to wait 3 days after mailing. It may take them a day or two from our request to make that mailing. Another item we need to look at. Gone are the days of in by 9, out by 5. And yes, we have closed some loans that fast in the past. There is a minimum of a 7 business day period from the date of the initial truth in lending statement to closing. So you've got basically 10 days at minimum because it's business days before somebody can close from application. If you add to that the mailing times, and assuming that there are no changes to truth in lending, then 2 weeks minimum is what to look at. So no quick closes, guys. Again, fees for non-credit reporting services may not be collected. May be collected once the borrowers have received the truth in lending statement. If it's mailed, we assume 3 business days. If it's delivered by email or fax or hand, if we have proof of that receipt, then we can stop those mail days. So if we were to fax a truth in lending out or email it out, and the acknowledgement of an email received comes back, which we have that ability here at Trustmore, or the borrower will fax back a signed truth in lending statement, then we can stop that 3-day mailing process. Or if we were to mail it out on a Tuesday and the borrower receives it on a Wednesday, which is typical, and they were to sign and fax a copy back to us, then that would also stop the mailing time. We cannot even collect a credit card number or a post-dated check for payment of services other than the credit report. Typically, we're talking about appraisal fees here until this disclosure has been made. So it may take another day or two after the time lapse has gone for us to be able to collect a credit card number or to obtain a check from the applicant to pay for that appraisal so we can order the appraisal. All right, so let's take an example here. Let's say that on Monday, that was August 3rd, a couple days ago, lender mailed out a truth in lending disclosure. So we took the application on Friday evening. So day 1 is Tuesday, August 4th. Day 2 happened to be today, August 5th. Day 3 would be Thursday, August 6th. And again, on day 4, because they received it, it's been 3 full mail days. We may now collect a credit card number or a check from the borrower to pay for appraisal services. Borrowers are not allowed anymore on conventional loans to pay the appraiser direct, part of the HVCC.